insist on them
Yeah.
during the presentation.
During the presentation. Please interrupt me. It's your lunchtime. Thank you so much for coming. It's one of the enjoyable interruptions of my work as a head of department that I can from time to time give a talk on what I love and where I feel a lot of purpose and sense. So this is research, and one of my research subjects recently is machine learning technology in the world of banking and finance, which is a subject which attracts a lot of interest and is even attracting more recently. It's very dynamic subject, so there are new applications appearing almost daily on the one hand, and on the other hand, it is still arriving in a landscape of financial industry, which is, as you know, very regulated and therefore not yet fully populated by machine learning or artificial intelligence applications. I think I will try to pick you up also if you are not very familiar with finance a little bit at the starting point, explain you about some already a little bit older application of machine learning technology to finance, and then I show some recent aspects what we are working on, and might also give some outlook for the future. And as I said before, I prefer and I insist on questions if you have any. So as we all know, and it's not true for any time in history of mankind, we live in exciting times. So we see a lot of progress currently in a field which listens to the name artificial intelligence and which is well known since decades. Recently, we see a lot of progress. And to mention a couple of examples, artificial communicators. This is most recently very often in the media, large language models. Older but still interesting applications, artificial board game players. Why do I mention it? Because it somehow fascinated me when I saw it first time, since I grew up studying mathematics or studying applied mathematics with statements like, it will take decades until von Neumann architecture computers are that far that they can beat by optimizing strategies the Go world champion. It was considered as something which is too complicated to be done by computers, and therefore it will take very long. But decades passed quickly, and 2017 it was actually happening that the Go world champion, to his greatest surprise, was at least beaten a couple of times, almost, I think it was 50-50, by a tabula rasa board game player, artificial board game player, and apparently implemented on a von Neumann architecture computer. We also see recently weather forecasting engines based on machine learning technology, or very famous, if you talk to mathematical biologists, protein foldings, something which usually takes a lot of computational power and can now be done by well-trained artificial intelligence implementations. What we do not see so far, but I think we are just on the edge of seeing it very soon, are economic or social predictions, or also political decision-making, negotiation of complicated matters. We will see in the arrival of large language models also that these types of applications enter the arena, and this also means that in the area of finance we might soon face new types of applications. But already there are a couple of applications, and some of them I will present to you and show you a little bit what has been done and where it might develop into the future. And altogether, these are problems which we often use as examples for the limits of classical technology and where we see surprising or completely unexpected solutions or implementations. So finance and economics, if you look at this subject, let me just go a little bit further that I have all the bullet points here. What is finance and economics? Abstractly speaking, it's the transformation of information and preferences into decisions, prices, and allocations. Every stock exchange does nothing else than transforming information the individual traders have via trading decisions into allocations in portfolios and prices of the traded goods. It takes place on all sorts of scales, so that's somehow unusual. It's a little bit like physics, where you also have on the scale of milli or nanoseconds events happening, and on the scale of trillions. Not in the case of seconds, but in the numbers which are around. So, but from a machine learning perspective, this is also interesting to see that the different scales play actually a big role. It's a non-linear, non-stationary, full of quantitative challenges world, and it has been since 100 years, I would say, a major consumer of new technologies. So when you look, for instance, the Black-Scholes model is born at the beginning of the 70s, and the fact that this model arrived changed also the way how markets were working. More contracts of certain types, of these nonlinear types, could be traded because the risk management of such contracts could be understood better. And it was also a consumer of new technologies in the following way. When you look at the Black-Scholes theory, I don't know who in the audience knows it. It is a linear PDE. This is maybe not the most modern technology in the 70s, but it's also stochastic analysis, a stochastic integral technology which existed in the 70s about 20 years, but people understood that well, how this works. It's interplay between stochastic analysis, Ito calculus, and PDE theory leading to risk management decisions, which in many cases worked, in some cases, which are usually well known in the history of crashes, did not work. So there's work to be done to make it well working. But I just give this as an example that the financial industry has always been a major consumer of new technologies in mathematics and also in computer science. And nowadays, we see the interaction, a strong interaction with machine learning and artificial intelligence applications. And again, to just set the frame, and then I show you an example. How is the classical approach, true, for instance, for Black-Scholes, working? So the classical approach works the following way. You have a pool of models, which you consider modeling a segment of the financial market. And you have some data, these are observations of this financial market. And given those data, you are choosing one of the models for the purpose of doing something with it. This is usually called the procedure of calibration. And everybody who is in financial industry knows here already in the first bullet point lies a lot of work. So this is an inverse problem. You have to clean the data. The pool of models has to be understood well. You need it real time, so you should not lose much time when you make this model choice. So already this is a good part of modern quantitative technology, and every trader could tell you many, or every quant could tell you for many evenings which problems are there. Then given a model, you use all sorts of techniques from Ito calculus and certain basic principles like these no arbitrage principles, optimization technology in order to calculate prices and hedging strategies. Dimensionality is always a severe constraint. So when I started to do mathematical finance about 25 years ago, this was the major question. How can you come up with models where analytic tractability is given? This means that you can relatively quickly get an idea of solutions of PDEs related to that model. Relatively quickly means in 30 seconds, not running a computer for half a day or such a thing. And as I said before, fine tools from statistics, approximation theory, inverse problem theory, they have been developed in order to deal with those issues. Usually those models, which you classically consider in this pool of models, these are models with a couple of parameters. This is, of course, in full contrast to what we do in machine learning. So in machine learning, if I may describe a machine learning approach to do to those situations, you have also a pool of models, and the models can even be classical models, and you try to choose conditional on data a model or a cloud of models. Then you are parameterizing or modeling the trading agent's decisions in each model up to some time horizon to trainable path space functioners. So something which you also classically would like to do, but you couldn't. This was just abstract thinking. Nowadays, with all sorts of universality results and also the training technology available, this is something which can actually be done, and I will show you in a couple of minutes a little example or an implementation of that. Then you represent the preferences of different agents, market frictions, all sorts of constraints you have within a loss function, and then you train the agents and store the experiences for each model. And you can combine, if you have a cloud of models, those single actions by posterior weights, given this cloud of model you have been calculated at the beginning. And in contrast to the approach before, this is an approach which is ridiculously over-parameterized. So the trading agents' decisions are modeled by, let's say, neural network with hundreds of thousands of parameters. The training time is usually relatively short. And from a perspective of classical approaches, where everything has been done in a very precise numerical analysis-driven approach, it is still extremely surprising that this works, that it works so well. And therefore, it is also seen critically by regulators. Yeah. Well, let me just show you a little example how that looks like. Yeah. Let me just go here to a full screen, right? Let's make it a little bit smaller. So the program I showed you before, this machine learning approach, is realized in one of the first papers we did in my group. This is by Hans Bühler, this time at JP Morgan in London, Lucas Gonon, a PhD student of mine, Ben Wood, also at JP Morgan, and myself. And the paper is called Deep Hedging. So it is just a machine learning implementation of the task of hedging. Hedging is the task of risk managing positions in a financial institution. So as I said before, usually this has been done, let's say, if we choose here a fixed model, so we have already done the calibration procedure and the model pool consisted just of Black-Scholes model. So this has been done by solving certain equations in this model world, which is the Black-Scholes model world, right? So there's a little bit of technology here necessary, but let me just explain the problem to you. So the problem is the following. You have a stochastic process which follows this differential equation, And given the input noise, you have different scenarios. So these are, you can imagine all possible scenarios a financial market can take. It can go up, it can go down, it can go up and down, and the other way around. All possible scenarios are encoded in this stochastic differential equation. You have typically for classical models, well-interpretable low numbers of parameters. So here you have S0. This is the price of the object you are interested in today. Let's say this is the price of the Google stock. You have the volatility sigma, something which is usually relatively well measurable. And you have a drift, which you subjectively expect the market to grow with. So these three quantities, three model parameters. And then you can ask yourself about a risk management task. What is a typical risk management task? All the guys in finance could explain you immediately. You have a contract. This depends on the future outcome or the future value of this underlying, let's say, Google stock. You could say in a year, if the Google stock is above a certain value, you get the difference to that value. And if it is below, you get nothing. So a nonlinear, for computer scientists, ReLU type contract. So it is just linear if it is above, and otherwise it is zero. And you would like to know what should such a contract cost? So how much do you charge a customer for that contract? And how do you hedge your risks? Because if you sell the contract, of course, you have to pay the customer if the customer wants this positive outcome from you, and you don't have to pay anything if it is below this strike price or this threshold. So this is a very classical question, and many, many contracts on all possible stocks and indices and bonds of this type exist and are traded every day, and they provide an important a contribution to modern economics. So it's an important question how to come up with a price for this thing. And the Black-Scholes theory gives a very clear answer to it. The price is the expectation with respect to a measure which is constructed within this model. And the holdings you have in the stock in order to hedge the risk are given by taking a derivative of a conditional expectation. So mathematically something which you do not easily explain to your kids. You need to study in order to get that. And it's a non-trivial thing. Therefore, I meant major consumer of technology. That's really not something which is easy to see. And with the master program in mathematical finance, you learn how to understand that. And well, what does hedging now mean? I should tell you, hedging is just a thing. You have come up with a decision to charge your customer a certain premium. You get the premium and you ask yourself, what do you do now with that premium? Do you put it in your bank account? Do you put it in your pocket? Do you invest a part of the premium in the financial market in the hope that the market allows you to generate the necessary liabilities in case you need them? Yeah, that's the idea of hedging. And the Black-Scholes theory gives a very precise solution to this. Namely, that you can fully hedge away the risk. And the Black-Scholes theory is just the solution of this problem. You just say, this is what the trader, what she is doing. This is the premium she receives. This is the liability you have in the future. And you try to make that difference as small as possible. So now you as computer scientists already are in your arena of comfort. You just say, okay, this is a least square difference of something which is living on scenarios, the different scenarios of the market. This is what the trader is doing. So you could model that if you understand precisely what trading means by trading decisions. So these are neural networks on the available information. This is a neural network on the available information, and you try to minimize that by optimizing the parameters of your thing. You would say it is maybe a little bit unusual type of objective function or of a loss function here, but it fits into a generic loss function framework. It's not standard loss function, but it works. So off we go. This was just the idea of our paper. So we set up that, and we have a financial market here. You have 100 trading decisions within a year. So this t equal to 1 means a year. The initial value of your asset, let's say the Google stock is normalized to 1, but you could have any other value here. The strike price is 1. So if the Google stock is above 1, you have to pay to your customer the difference. If it is below, you have to pay nothing. So your liability is just given by ReLU applied to S minus 1, right, in the future. And the volatility is 20% per year. This is how the stock is fluctuating, right? Black-Scholes theory would give you an answer here. And just that you see, so again, it's not completely exaggeration what I said before. It's a relatively long formula. It would probably end somewhere here. So this is the Black-Scholes formula. This tells you what would be the price of this guy in this financial market. And when you look at it below, you get something like 0.079 units of currency. So in this model and under these market conditions, it costs 0.079 within the Black-Scholes model to have such a contract, and the hedging strategy is also coming here. But here we are not evaluating the Black-Scholes theory. We put ourselves rather in this modern machine learning paradigm, and we say we are training an apprentice. The apprentice is given by neural networks, and the guy is learning on market scenarios to train better or to trade better and better and better according to the objective functional. So you have some networks here. This is the way how you write down your objective, admittedly not a standard way, but possible. Well, takes a little bit of a time. I was running it before. And here you see, and let me now just continue the training. Here you see already the training procedure. So I was training it before, I think for 2 minutes or 3 minutes. So it goes relatively quickly to make your guy learn on 100,000 scenarios of this market to trade better and better and better. And what you see here, the loss is proportional to the square root of the loss is proportional to the variance of your, no, this is the standard deviation of your hedging histogram. Yeah. So the way how you are actually hedging your liabilities, which you have in the future by investing in the financial market. And the funny thing is, what you would not have said before, and this is the reason why we wrote that paper, if somebody had told me or also other bankers or people in quantitative finance that such a method has a chance to work, because it is really extremely directly implemented with a ridiculously over-parameterized family of parametric family, you are just trying to model tabula rasa, not knowing anything, apprentice who is on your trading desk, and you try to make the guy better and better and better by just letting it train again, go again through scenarios. Yeah. The loss function is, let me show it to you abstractly and not in the code. The loss function is, after discretization in space and time, just liability in the future along the scenario omega I minus a network of the available information. This is the premium minus the value of the hedging portfolio. So you like this the stock price all the way? Absolutely, 100,000 times. I have a model. Here I use machine learning just as an alternative of solving the PDE. That can show as a cross-form solution, right? Absolutely. Absolutely. Therefore, I can to approximate. No, I use machine learning as a numerical method to approximate a solution. I don't give it a solution. So it starts here with no knowledge. What is the advantage of doing that? The advantage of doing that is that any type of market friction, any type of complicated liability, you can precisely do the same thing. With Black-Scholes, you know very well, for the vanilla, you have a solution, but already if you introduce market frictions like transaction costs, Black-Scholes is gone. So the beauty of the machine learning approach here as a numerical tool is its extreme robustness. You can apply it in any sort of situation. Nobody tells you that the scenarios have to be generated by Black-Scholes. And nobody tells you that you do not add frictions, liquidity constraints, a more complicated payoff. It's robust. Yeah. Absolutely. You are now in the language of asset pricing, and this is more mainstream. You can do precisely the same. You can. Absolutely. Yeah. I would formulate it abstractly. Any type of economic or financial economic thinking, which so far was in your head and somehow is a model for the world of financial economics, you can, with this technology, realize numerically. That's the somehow surprising aspect. Without solving PDEs and without even using the solution for special cases. Does it answer? Please. Almost. First, we do not say optimal market, we say complete market. So this means that all risks can be fully hedged. And it's one particular model. It assumes this. This is in this modeling setup. But as I said before, if you take this as a generator of your training data or something else which is neither complete nor having a random walk hypothesis behind, still the same. You can use precisely the same loss function, precisely the same training. The only thing which will change is that your hedging loss will not converge to zero if you make everything finite. Okay. Say that again. I didn't. Absolutely. Absolutely. You could do it within a Black-Scholes theory, but then the technology gets really complicated. I give you an example. Black-Scholes is without transaction costs, and this is already something you have to learn a little bit in order to understand it. If you do it with transaction costs, this has only been solved 25 years ago. These are big papers, long papers. This is implemented somehow, but you really need a specialist to read such a paper. The technology gets complicated, the classical technology, and the fascinating thing about this machine learning approach is that it is extremely robust, like a Monte Carlo solver for a linear PDE, something you can use always, and it gives you a reasonable number. Absolutely, your model should be arbitrage free. Otherwise, you run into big losses or gains. No, completeness and no arbitrage is not in control. You can have no arbitrage and be incomplete. It is just incomplete means you will not get rid of any risk. There might be risks which are just unhedgeable. So Now you see here our poor apprentice. He was going, or she was going through a couple of steps here. The loss is already relatively small. I don't show you now the evaluation of it. I did one before, not an extremely good one. But you see, what is the price predicted by the apprentice? 0.08 in comparison to 0.079, already very good. Nice. So without knowing anything about Black-Scholes, after 5 minutes of training, it gets it. The price is correct. The hedging strategy is not very good. You would see Black-Scholes reduces it up to here, so it makes it quite better. But we were training only 5 minutes. If you train it 15 minutes, you're there. So that's an outline of this just very simple thought, which I said here. Replace the classical approach, solving a PDE using Ito calculus and so on by a machine learning approach, somehow yields absolutely fascinating results, which are more robust than the classical approach, in the sense that you can apply them in situations where you do not even have a classical solution. I don't know why that is now, but yeah. Any hope that this disappears? Yeah, it disappeared. So what is the difference to the classical approach? The difference to the classical approach is the following. This is a big philosophical difference. In a classical model, we have a few interpretable parameters. Usually you also know what those interpretable parameters mean. If you ask our colleague about asset pricing, he will tell you, well, the sigma is that and that. You can read it off there and there. There is a little bit of consensus in the market how big it should be, and the mu is less consensus-based, and so on. Few interpretable parameters. The machine learning model, completely different. Let me try again the method of, yeah, whatever. Let me just try something and then I come back. Maybe this helps. Okay. So the machine learning model, completely different here. We solve a numerical model as within the classical framework, but we have many parameters. We do not have a numerical guarantee that things converge. We just have empirical evidence that things work. We have a little bit of theory why this overparameterization, which is in contrast to these classical principles like Occam's razor, the fewer parameters, the better, why these models have a chance to work. But we are driven here a little bit by the fact that we see solutions which we did not see before, and as it is in this, for instance, a trading model, that we are able to check how good the solution is. You have to imagine, in contrast to maybe a self-driving car or something else, here you can actually check the quality of your solution by just saying, okay, I generate test data, and on those test data, I see how well the solution is. And in that sense, it is a paradigm change here in finance, a paradigm change in the sense that these highly overparameterized models, which use machine learning trading technology, provide the same solutions as classical models in a relatively quick time, but also solutions in cases where we did not see solutions before. So that's an interesting starting point for letting machine learning enter the world of finance. So how did it look in the last years? There have been a couple of papers from my group. One is about the hedging problem, as I said you before. So this you can see as on my webpage in my lecture, Machine Learning in Finance. Another one is the calibration problem, how to choose a model out of a pool of models. Another one is this simulation approach or deep simulation approach, where it is about generating market trajectories which are likely to happen, but where you somehow try to construct by machine learning technology models. As I said before, we see solutions of problems which we did not see before, and we have this fully realistic modeling. So we can do high-dimensional risk management with trading constraints, with transaction costs, high-dimensional calibration problems, and these highly over-parameterized networks still work, even though this is all against the good habits how we were doing finance 15 years ago. Just to mention a little bit and to set the arena for what is coming now in the next 10 minutes, 8 minutes. It is not only application of machine learning technology what we do here, because some of the problems in finance, they are come with a flavor of finance. For instance, in finance, you need to include the arriving information immediately. It's the most important information you have. What is the current price? Yeah. So this means always what arrives now in the moment is something which is immediately has to be included in trading decisions, into risk management decisions, and it needs quick way of incorporation time. This is a particular feature of finance. These the classical models yield, but it is something which needs, from a machine learning perspective, as a little bit of theoretical development. And one of the theories we recently tried to work on is this universal approximation theorems on path spaces. What is a path space? A path space is the collection of all scenarios you have in a financial market, and the universal approximation theorem thereon is just a way how to construct neural networks taking paths as an input, and which can easily be updated if new information arrives. So if the path is getting longer and longer in time, you can easily update your network by the newly arriving information. Sort of, let's say, special types of recurrent networks, pre-trained recurrent networks, where the input information is just the input of the recurrent network. And one aspect I want to show you a little bit, that you see a little bit what is happening on the theoretical side, goes then towards an actually relatively old branch of machine learning called reservoir computing. So you can say it in a modern language, these are partially trained networks. Networks where a good part of the parameters are chosen randomly, and you only train a subset, sometimes a very small subset of the network parameters, still achieving relatively good results, sort of random feature selection. And this is related also to a field which is an old love affair of mine, signature, rough path theory, signature transforms. So a theoretical framework how to construct features on path spaces, but a very precise way how to do it. Let me show you in the last 5 minutes how that works. So first, as I said before, technology which we need is universal approximation theorems on path spaces. So input and output are paths of, let's say, financial markets. So this can be recurrent neural networks, but maybe with a slightly higher dimensional input structure, and where we would like to have a relatively easy training procedure. And this paradigm of reservoir computing just says the only thing which is trained is a very small subset, the so-called readout part of your network. And the rest of the network, which is, let's say, recurrent cell producing out of the input hidden state, is just randomly initialized and remains untrained. Fascinating thing about reservoir computing is also its sustainability. So the funny thing is often these reservoirs are realized physically, meaning you're leaving the von Neumann architecture paradigm. Some of them are done with optical computers. So you take a laser, put the information of a time series modulated on the laser, let the laser run through an experiment, and then read out some densities at the end of the experiment. And this is considered a random nonlinear transformation of the input and used then as features of the input. But of course, instantaneous calculation. And funny thing here is also that it works quite well with generalization tasks. So just to say you a little bit what this signature transforms is. So this is a typical path space or Lipschitz path on some time interval with values in RD. Signature transforms are these iterated integrals, so iterated integrals of the different components of the path with respect to itself. You can imagine that there is, even though this is a non-trivial statement of modern mathematics, there is a universal approximation theorems, so that the collection of all those features, of all those iterated integrals, actually provides you with an exhaustive list of features of the path, like a Weierstrass theorem, but on path space. And you can even prove a little bit more. If you have any equation driven by such a path U with some vector fields, you can write the solution of this equation, evaluate it with some test function as a linear combination of those signature objects. So that's a way how also to check this universal approximation theorem, but in a quantitative way. So this is almost like a Taylor formula, right? This is not really what is meant with a reservoir, but you could say the collection of all signatures is actually something like a reservoir, even though we do not have yet these random features. And not going here into the mathematical theory, but just showing you that there is a very nice and simple way how to get to these random features and the theoretical explanation for it. So if you replace the collection of iterated integrals signature by a Johnson-Lindenstrauss projection, so a random projection on a certain algebraic object, you end up with another way, or with a random compression of the information in signature. So this is a full list of features, randomly compressed. You get random features which are not completely exhaustive, but almost, and they can be written like a differential equation with some random matrices here. Random matrices but untrained. And there you have the same phenomenon that you actually can run regressions of all sorts of nonlinear functionals, for instance, solutions of equations driven along this path U, regressions on those random signatures. So this is one way how to justify why random recurrent networks or random reservoirs which remain untrained are actually a good way to extract features which can be used in order to represent path-based functionals. And if you have new incoming information, you just solve this equation a little bit longer and the new information appears at the end. So that's a very good way how to use that also, for instance, for trading strategies. And let me just show you in the last 2 minutes how such a path space No, it did not really show what I wanted it to do. No, where is it? Yep. Now one sees it. It was already selected. So this is one simple example where you see a reservoir working. And so I will take a particular solution of this equation for a two-dimensional complicated input, which is a Brownian motion and some vector fields. I don't even need to show them to you. I just show you how that looks like. So this would be the input noise. These are two trajectories of Brownian motion. And this is a dynamics which we would like to learn. So the goal is understand the map from here to here, a nonlinear map. And the paradigm of reservoir computing is very simple. It just says, take the red curves, your input, take a random equation running on the red curves, produce a hidden state, and then make a regression of those guys on the hidden state. Remember the regression coefficients. So here you see the result of the regression, which is, of course, surprisingly good. We have only been training up to here, but it predicts up to here. It really gets well the dynamics. Blue would be the reservoir, the regression coefficients. Green is the original dynamics. And when you go now to another element of your path space, so this is the generalization task, you see that actually the prediction is extremely good of this system. So this is one of those examples of reservoir computing, just telling that these randomly chosen, untrained path-based functioners, which are easy, or where you can easily incorporate a newly incoming information, they're extremely versatile to represent all sorts of complicated path-based functioners easily. So if you were doing here, by the way, the calculations, the training, this is more or less all instantaneous. You do not train anything nonlinear. It's a completely convex thing. Everything which is nonlinear, which is hidden in the recurrent cell, is untrained, just randomly chosen. I mean, the yeah. If I had a little bit more time, I was applying it below on. So these are highly dependent prices of financial markets, normalized here to 1, but this is just a standard financial market, and you can run precisely the same type of analysis here. You find it on my webpage. This is for those. You can learn the dependent structure. And so here, these two trajectories, the green ones are dependent. So there's a dependent dynamics, which you see here as well a little bit. Good. I think I have spent enough time in order to show you a little bit the fascinating aspects of finance. I hope I could at least a little bit entertain you also during your lunch break, which you devoted to listening to me. There's still a lot going on in the area of machine learning in finance, and we might see completely new applications, in particular when it comes to large language models. And also the word of uncertainty quantification, very important in finance and very important from a regulatory perspective, is now seeing machine learning applications arriving. And With this, I conclude now. Thank you.
In entertaining us, but also educating us, more importantly. Do we have any?
In the deep hedging example, we consider the European option. Have you considered more complicated ones, like for example, the one where you can exercise the option anytime before
American options, yeah. I mean, as I said, the beauty of this approach is that it is completely robust with respect to any type of task you impose. So actually, we were doing a nice American option exercise, I would even say now, where we do everything for this with reservoir computing. So you take not neural networks, which you fully train for the apprentice to parameterize the trading decisions, but you take reservoirs of the past, and then you have a convex problem, a convex learning problem. But you learn then also the exercise time, the American option. Yeah.
That would be a question, that how do you decide then if it's exercise? You have to somehow find a policy function for.
Yeah, you solve this optimal stopping problem. So you use some networks which are quantifying the trading decisions, and you have the value function. Then you compare the value function with the conditional expectation with respect to the martingale measure, and this gives you the trading decision. So it's like always, what we always had in mind when we think about certain problems, you can make running by just implementing it in that way. Yeah. Other questions or remarks, please? Say it again. Why? I don't use the PDE here. No. No, I don't use the PDE. The physics-informed networks do the following thing. You try to approximate the solution of a PDE by taking the PDE itself in the loss function, saying it should be satisfied somehow. I find this approach sometimes very good, sometimes suboptimal. The reason why it is suboptimal is that it a solution of a PDE is a delicate diva sometimes, in the sense that it has different time scales appearing, and solution of a PDE might be well chosen, but still the first or second derivatives of the solution don't work well. We try always to formulate objective functions which are more robust, in the sense they don't need a PDE, they rather need a goal. And here you have a clear goal. The goal is make the liabilities for the owner, for the seller of the contract, as small as possible. This is a much more robust because it does not contain derivatives inside the network. So in that sense, it gives similar outcomes than physics-informed networks, but with a more robust loss function or objective function. You cannot always do that, but in finance, usually you have relatively robust objectives. You would never in finance find a trader saying, I want to minimize my second derivative of something. You rather have a certain objective. Yeah. Yeah. But the goal is the same. You try to solve an equation. Please. The advantages of this little method here, what I showed you before, you could immediately into the training include stress scenarios. Stress scenarios could mean scenarios where you say you have a liquidity squeeze. And you can adapt your trading strategy not to completely get crazy in this situation, because 5% of your scenarios are of such a type. So you do not need to choose everything from Black-Scholes. You choose 95% from Black-Scholes and 5% of convincing scenarios for the regulator or for your goal, what you have. In that sense, yes, we tried that. And then the strategies, of course, change. They're a little bit different, but more robust with respect to those troubles, which we see from time to time in the markets. Yeah.
Yes, of course, as you state, I mean, the domain, we offer sometimes for other domains to validate standardized publicly available data that sort of provides some standardized tasks that people are generally established also.
So you're looking for prediction tasks in order to test your time series models. I would say in the world of econometrics, I mean, you can just go to classical literature and look at when it comes for volatility prediction, you have a whole of literature talking about that, how to do that well. Usually this is one-dimensional literature. I suppose if you come from healthcare, you have multivariate inputs and outputs, and it might be interesting also the other way around for econometrics to see those models. But there's not really a standardized literature, this I cannot say. But we should stay a little bit in contact because one of my students, Florian Krach, we have been developing, let's say, very non-parametric machine learning driven models in order to do prediction tasks also on healthcare data, but not only. So these are somehow generic prediction machines and high dimensional. So we can discuss a little bit on that. Yeah. Thank you.